Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Joining me today would typically be Michael Becker, but again, he's on assignment doing some additional due diligence. So in the podcast today, we have Dave Walls, also with Old Capital. Hey, Dave, how are you?
Paul, how you doing?
I'm doing great. So in the podcast today, we're on the Central Texas road trip, the road trip that never ends. And if people are not familiar with Central Texas, some of the towns in Central Texas you may be familiar with is Austin, San Antonio, Waco, and all different types of interesting economically charged areas. It's kind of the heartbeat and the backbone between Dallas and Fort Worth and Houston. Just a tremendous amount of activity going down in Central Texas. So we're going to talk a little bit about what's going on down here in multifamily. And in the podcast today, we have two gentlemen that pretty much are the industry experts down in the Austin, San Antonio market. And so we're going to have a chance to kind of visit with them and kind of have just a general conversation about what's going on. So in the podcast today, we have two gentlemen. One, Scott LeMontagne. Scott is with JLL. Scott, thanks for being here with us.
Good morning.
And also we have Zar Haro, also with JLL. And Zar, how are you?
I'm doing very well this morning. The drive was a little hectic up here, getting up here as our state's growing. Getting between Austin and San Antonio can be a little difficult.
Absolutely. I mean, we are in the JLL conference room over right off the 5th Street. Just absolutely gorgeous view of downtown Austin. And I could tell you the state bird is the whooping crane. Dave, I don't know what the state bird is, but I can tell you in Austin, it is the building crane. There's a tremendous amount of cranes that are out the window here. We just see a bunch of building going on. Just a great view of Austin. So we're down in Austin. So I want to get to know a little bit more about Scott and Zar. So Scott, tell me a little bit about what your background is and a little bit about what you do.
Sure. Prior to real estate, I spent the first 12 to 15 years of my career building small companies and sold my last company in January of 2000 and began to, frankly, look for what I was going to do next. I was young, wasn't ready to retire, and was looking for apartment deals, and came across, offering memorandums, started to get to know some of the brokers, and decided that it would be a path that I could do. And so that's how I got into real estate, and that's been 16 years ago now.
Wow. So 16 years in the multifamily business. Now you live down here in Austin, but you've been in several locations, so you have a little bit of a diversified background. So you were out in California for a little bit. You were in Dallas for a little bit, up in Oklahoma for a little bit. Mm-hmm. What's your favorite place so far?
So Austin's home.
Austin's home.
My kids will grow up in the house that we're in now for sure, and we're not making any more moves. No, when I first started, I started as a multifamily broker in the Dallas office for Marcus & Millichap, and having a business building background, I quickly assessed that we could create a lot of different leverage within the Marcus & Millichap system. So we built a team that grew to 12 agents in about 18 months, and by my second full year in the business, we completed 56 apartment transactions and kind of grew from there. A lot of people know Nick Fluellen, which was one of my very first hires and ultimately became my partner and took over the team. I went into management, went out to Southern California. I ran the operations for Marcus & Millichap in Southern California, and I also was a division head. I ran the special asset services group for the western half of the United States as well. And then, I figured out, like a lot of people, that being a broker is more fun than being an executive. So I came back in the field and came back out this way and made my way back to Texas. And we chose Austin as that place to go.
Beautiful Austin down here. And again, Scott is the team lead. He's the guy who oversees a group of 11?
11.
That's great. So Zara, tell me a little bit about your background, where you're from, where you went to school, some of those important things.
Good old San Antonio is where I'm from. I went to school at UT San Antonio.
Great school.
I did have a small stint in New York City doing structured finance, investment banking for real estate, and then got homesick and wanted to come back to Texas, and ended up meeting Scott at Marcus & Millichap almost 9 years ago now. And so we've been working together in different capacities. I was running a separate team, and then we figured out some synergies, and we all decided that coming together was a great idea because we had a lot of synergies just amongst all the things that we were doing.
That's great. So what people probably don't know and maybe don't understand, and let me know if I'm wrong about this, but in the residential real estate business, because you guys are multifamily realtors, really. In the residential, from the 1 to 4, maybe there's 40,000 residential realtors between, say, Waco all the way down to Victoria, to McAllen or something like that, and all the way out to from Texas A&M all the way up to here, Austin, and 40,000 realtors that sell 1 to 4s. But in your space, there's probably 18, 16, 17, 18 apartment brokers in that same area, the ones that actually do business. So,
Sure.
So instead of thinking that there's a lot of brokers out there, there's only a few, and these are two guys that you really want to get to know because there's not a lot of other people doing this type of stuff. Am I right about that?
Yeah, and I would say kind of in that more private, kind of 8-foot ceiling, $1 to $25 million space. You're right. You're dead on. When you start getting into the institutional, the larger assets, then there's really probably 4 in Austin and really 5 in San Antonio groups that compete for that business. So it's a pretty narrow pack.
That's good.
But it is very highly competitive.
Highly competitive. Let's kind of talk a little bit about what's going on here in Central Texas. How's the economy these days? I mean, what are you guys seeing? Is it a good market? Scott?
Sure. So, yes, the short answer is yes, and it all stems from employment growth. And both Austin and San Antonio have done very well this cycle on employment growth. Austin's averaging about 4%. We're down to about 3% right now, which is about 30,000 jobs. 4% would be about 40,000. San Antonio's done very well this cycle. And matter of fact, San Antonio's rebirthed itself in a lot of ways this cycle. We've created a bit of an urban core in San Antonio. And in addition to that, we also have become a little bit of a hotbed for millennial in-migration in San Antonio, which a lot of people don't realize that there's a very strong millennial in-migration. So the dynamics in San Antonio are changing. We know Austin is a big tech city, very fast moving, very high growth. On our population growth in Austin, it's 157 people per day move to Austin.
That's like a small 747 coming in every day and dropping people off, or 737. I mean, that's a lot of people coming to Austin every day. I mean, and a lot of people stay here if they go to the University of Texas and they never go home. And a lot of parents have problems up in Dallas and Fort Worth and Houston. All of a sudden, their kids come to Austin to go to school, and they never come back to the nest. So you guys have some magnetism that just stays in Austin. Tell us a little bit about JLL and tell us a little bit about the volume of business you guys do. Whether it's last 12 months or 24 months. Give me kind of an idea of business.
Sure. So JLL is a 240-year-old publicly traded company. It started off with a single auctioneer in a small town in London selling chattel. I mean, basically, if you wanted to sell your buggy, or you had some farm tools that you wanted to sell, you take it to the guy and he would auction it off for you. That's how we started. Over the years, obviously grew into the second largest real estate advisory services firm in the world. We have 65,000 employees and literally touch every continent.
That's amazing.
We're part of the capital markets group.
Yeah.
Capital markets is comprised of investment sales and investment banking. And our team specifically is capital markets multifamily. And we essentially do 4 things. We do land for multifamily. We do debt and equity for multifamily, structured finance. And then we do investment sales, which is the bulk of what we do. From a volume standpoint, this year, depending on, we've got a very large fall lined up, and it depends on what closes in 17 versus 18, but we could be as high as, $825, $850 million on our team volume this year.
That's pretty good. And I know Czar has a lot of that volume going on. How's everything going down in Austin?
In San Antonio?
In San Antonio, sorry, San Antonio.
Yeah, no problem. Everything's great. It's interesting how people compare Austin to San Antonio, but San Antonio really does have its own personality. And it was in the shadows for a long time of the second choice past Austin. But as the urban core is starting to develop, you're starting to see a lot of the tech hiring hangover come into San Antonio. Traditionally, it's been military town that was kind of the steady Eddie. We're starting to see some real fueled growth. You're seeing people down at the Pearl throwing frisbees, drinking beers on the lawn. So it looks a lot like the growth path that you see Austin went on, but it's unique to San Antonio. I mean, it has its own identity. It's still, a 60% Hispanic city. So you've still got a big culture of a lot of Hispanics in the area. So it's also the oldest city in Texas. So, I mean, it's about to be on its 300-year anniversary. So it's been here forever. So it's hard to take the soul out of it and sell it to what we call the Austin Devil. And it won't let itself kind of leave its own culture. But from a growth standpoint, we're seeing very similar metrics. The returns up front in San Antonio, meaning that the returns on cap rates are a little better, but we haven't traditionally seen the same rental growth as Austin. But if you're looking at a 5-year hold, the returns to Austin and San Antonio are almost identical on a 5-year hold, but you're getting more cash flow in your return in San Antonio, and in Austin, you're getting a little bit more appreciation than cash flow. But in a 5-year hold, essentially they're almost identical.
Equity's really underwriting to the same standard, right? So you're just getting to it a little different way.
So is capital still coming to Central Texas, and why?
It is, and I would say that despite the fact that we've depleted a lot of the value-add transactional inventory this cycle, that remains to be the hottest segment. What's probably cooled down a little bit right now is in the core space. Frankly speaking, the more new and trophy product, a lot of the core funds have been pretty silent in the last 6 to 12 months. But in the value add space, we see a lot of activity. And just to give you an example, we've got a 2000 vintage value add asset in the market right now. And we've literally been in the market for 2 weeks, and we'll do our 18th tour on that asset today. So it's been pretty frothy. The reason why it's coming to Central Texas is we are an alternative to the East Coast, West Coast. A lot of people look at Central Texas as a way to get better yields than they can get in other areas. In addition to that, we've got such strong employment growth, and those dynamics, that growth dynamic, is really what has put Central Texas on the map and why we've been such a hot topic in the real estate industry. I think Austin was ULI's, number one growth city, coming into 2017.
One of the interesting factors too is that you're seeing capital that's getting imported that, as Dallas and Houston are always the first touch points when capital comes in, a lot of people are getting blown out by the major institutions that can go live or non-refundable money, $500,000 day one. And so individuals and private investors, even very high net worth individuals, don't necessarily quite have the stomach for losing $500,000 in earnest money if the deal blows up. And so you see that they come to Austin and San Antonio because they're not competing on the same terms. The returns are similar, meaning that cap rates are a little lower in Dallas, a little higher in Houston, but you're also seeing that they can actually buy opportunities here with maybe not necessarily as aggressive of terms.
And I don't know if it's me but it's just the sense of feelings of the amount of business that we do in Austin and San Antonio. But I see, Austin is more of large family offices, large institutional people putting money into this area. I see San Antonio as a little bit of smaller family offices, more individuals, kind of like it used to be back, 20 years ago, where it was just one person or a small syndication buying it. I see that kind of two different dynamics of equity coming into this marketplace. What do you think about that, Scott?
Yeah, well, first of all, I see more of your closed tombstones down here than of my own, so you guys are definitely very active. No, you're absolutely right. Austin does tend to get more of an institutional play. The institutions come in and out of Austin, very cyclical. in very much in a herd mentality. But you'll see institutional equity chasing Austin as an alternative to the Sexy Six. We are a quasi-institutional city, even though we're a smaller city. We do compete in large part for capital with the Sexy Six and some of the other major metros. San Antonio very much is a family office market. It historically has been up and down the spectrum. While there are, more institutional buyers of merchant-built real estate in San Antonio, some of the largest owners of major assets are family offices. And when you look at development equity, unlike Austin, which we can very much attract institutional equity for development, in San Antonio, it's very difficult to attract institutional equity. And while San Antonio is a much larger city than Austin is, the institutions really look at it as being a secondary city, and it's just now beginning to really evolve into more of an institutional.
And what do you see with cap rate compression in the last 24 months? With BNC, and how long do you think it can go? How low can it go?
Well, I mean, that's a function of debt, right? So I'll let you guys have the crystal ball on that. You're closer to it than I am. But the reality is that, people are solving for certain returns. I mean, the small private syndicator is paying a 7, 8, 9, 10 pref, and they're having to get into the waterfalls above that. So they can only underwrite to the point where they feel like they can either be at or engineer a return that is going to put them into their waterfall. So that really is the function. I mean, if interest rates were to, on 10-year permanent debt were to drop down to 3, we could have cap rate compression. But right now, we're kind of in that 4.25, range on sort of 10-year agency debt right now. And we're probably about at our limit on cap rate compression. So what'll happen is what we see happen now on deals, while we're getting a lot of offers on the value add deals still, what we see is that the groups tend to peter out. The differential between first round and best and final offers has compressed a little bit. They're not stretching as hard on price. They're coming in harder on price up front to make the best and final. And then they're really competing on terms on the backside.
Yeah, the terms are the biggest thing right now. Is what everyone is demanding is, I think I mentioned it last night, we were with Dr. Dotzer last night, is that when we first, in this last cycle, we started off with no interest only. Then it became 1 year of interest only, and 2 years of interest only, and 3, now 4. Now we're up at 80% leverage at 5 years interest only. And you got to get the interest only because you got to tweak the returns back to the equity that needs a rate of return. So you've got to have the interest only. So
I agree with you, but I think one of the things that in this cycle that we see is a little different from last cycle is they were underwriting to interest-only debt coverage, but today they're giving you leverage based on amortizing debt coverage.
Correct.
So I think that's probably something that's going to help just bolster the underwriting for the lenders without having to see a big black swan event.
Yeah, we were in a much more precarious situation last time. And not only were we underwriting interest-only debt service coverage, we were also recasting our income in that time period.
I like that term, recasting the income.
So not a lot of distressed assets in your markets. So what are people looking for?
Value add, up and down the spectrum. I mean, everything from, C, heavy lift value add, all the way to, very light lipstick plays on, more of the institutional quality, 7, 6, 7, 8, 10, 15-year-old product. It really runs it. It's blended so much at this point, I can't tell you what the difference between a core plus and a value add is.
Mm-hmm. The way that we're designing our marketing plans to attract specific investors is if we believe what they call core plus or class A with a little value add funds, we'll say core plus deal. Or if we think that private individuals are going to step up to the table, we might call it value add or true value add, heavy lift. And so the way that we're marketing these assets is really trying to attract all of its value add money, but how do you design a marketing plan to attract that specific space of value add? Because one group may say, hey, I've got core plus money, but it's not value add money. At the end of the day, if an analyst gets convinced that that money can fit their bucket, they're going to deploy the capital.
As Dave says, there's not a lot of distressed assets down here. We've gone through this cycle, and people have probably done one or two different updated to these 1970s or 80s properties. Everyone's searching for yield and trying to create something. The hurricane happened just about a month ago or so, 3 weeks ago, 4 weeks ago. Are we starting to see any, this is a macro deal, are we starting to see any money try to go down to Houston at this period of time, or are we it's just too new and seeing things, money coming that should go here in Austin, San Antonio is going to go down looking for deals down in Houston?
Houston's been in a little bit of a depression since oil prices bottomed out, and we had a lot of supply. As we're looking into 2018 in Houston, the amount of supply that they're going to have is minuscule in compared to what we've been delivering. We've been delivering 16 to 20,000 units in Houston, even since the oil downturn. And next year, we're going to be, probably 2,000 units, 2,500 units in Houston delivered. So Houston was already on people's radar screen as an early comeback play. Mm-hmm. We started seeing that probably as early as 6 months ago. But taking, I don't know what the final count is, but roughly 30,000 units offline because of the hurricane really only exacerbated it because it put the immediate upward rent pressure on the assets, which have been giving away a lot of concessions. And so we have a client that we talked to that the weekend after the hurricane lists 51 units in a weekend. And so, people have to have a place to live.
Oh, yeah.
And a lot of those units are offline. It's going to be a 2 to 3 year process to be able to clear all that. I mean, just think of the amount of supplies needed, the sheetrock that'll be needed. What that's going to do to pricing on sheetrock. I mean, so yes, the answer is in short, yes, people are looking opportunistic in those areas and people are looking for yield. I mean, while there's been a little bit of a discount between buyers and sellers on the bid ask, people are trying to come back early enough to take advantage of that on the flip side now and maybe make a little extra yield for it.
You do see there's really two distinct camps of people trying to make distressed plays in Hurricane Harvey hit areas. You have the grave diggers that are still waiting to call people and the drywall hasn't even gotten dry yet. And then you have the opportunistic buyers that say, I don't really want to mess with flood damage type deal because it's really a new construction project, but we want to be in areas where one or two of these apartment buildings are still intact and in good neighborhoods that the rest of the stock's out of there, and we can start to see fast rental growth very quickly and move rents. Out of the 4 places that were hit, we had the Corpus Christi area, you had Victoria, you had Houston and Beaumont, Port Arthur, where basically all of the damage was done. The latest reports say that Beaumont, Port Arthur probably has the best upside in rental because so much of the supply was taken out of the market. And there you've got a lot of oil and gas, refinery, infrastructure from the government coming in. So just the natural
high renter profile. Yeah,
exactly. And unfortunately, the hardest hit areas were out of the 3,000 affordable units that were in the Beaumont, Port Arthur area, 1,000 of these units are offline. So you have the poorest of the poor people. They're probably going to end up moving to Houston. But at the same time, you see high income jobs that are in the area and a lot of units that are coming offline. It's going to be a faster move on rental growth.
So, you guys work in the secondary and tertiary markets too. I mean, I know you guys go into these smaller communities. And so between us girls here, what is the best area, secondary, tertiary market that somebody who wants to get into multifamily should be looking at? What areas do you guys like?
I like Corpus Christi. Some people will say, hey, look, there's been some hurricane disaster, but Corpus Christi is going to be the beneficiary because there wasn't really any damages. Most people aren't meeting their deductibles for windstorm because they're just not either able to or there wasn't that much damage. In the Rockport, Port Aransas area, you saw that there's a complete devastation of homes and things like that. So you'll see some good rental growth. On top of that, you'll see ExxonMobil had their big announcement that they're doing their $10 billion project. I imagine that there may be a little bit of a delay, but you're going to have a big labor market that's filling up all those units, and you should see some good rental growth. And now is probably the opportune time to get in there because once the rents start to move, then you're going to be paying much bigger values.
Yeah, I would agree. I mean, I really think, if you look at the Texas tertiary markets, and this year alone, I think we've closed in 8 different secondary Texas tertiary markets. So we've been pretty active in it. But I would say, follow the jobs, right? So where are the jobs? Well, petrochemical, chemical manufacturing, and where the ports are is really where, on the tertiary side is where the job growth is. But you look at a market like Lake Jackson, where you've got these massive construction companies that don't have places to house workforce housing, that they've got multi-billion-dollar contracts to build a chemical plant or multiple chemical plants, petrochemical, and they're literally subsidizing the developers to build. Mm-hmm. We've got 2 assets that we're going to take out in Lake Jackson that have income guarantees on them for 5 years from a investment credit rated corporation because they needed housing for their workers.
If it were me, though, I would, and this when I say me as in personally myself, deploying capital, if I ran my own management and I'm a private individual, maybe a couple investors, I like the Waco Temple Killeen market because it's easier to access. You're not paying the same returns. If I live in Dallas, I can get there in 2 hours. If I live in Austin, I can get there in an hour and a half. And you still have what we call grandpa that's dying. And you still see some good deals there where there's somebody that may not necessarily be on the rent systems, or they don't move. That person doesn't move their rents according to the market. So you still have individual families that may have been part of that town that still own a significant amount of stock. And when they sell, some of the assets are a little deferred, and you can find, in my opinion, better deals. Now, the brokers have gotten much better, and you're seeing a lot more technology moving capital all over the place. So somewhat of it's priced to perfection, but at the same time, if you can't get a loan on it, the value is going to come down.
Yeah, I don't think you need to be in, secondary, tertiary markets to get yield either. I mean, if you're doing the same thing everybody else is doing, you can guarantee that you're at best going to hit singles and doubles. You're not hitting home runs.
Yeah.
There are no steals out there. But you can go a little contra. So here's an example. So we've got a 136 unit post-renovated B deal out in the market today in San Antonio. And I guarantee you we'll get half the offers that we got on a similar neighborhood B value add deal.
Right.
But the cap rate on this will be 75 basis points wider than the value add deal will be. Mm-hmm. And, if you structure the finance right, as you said, with interest only, et cetera, you can hit the same type of opportunistic returns on an asset that you don't have to do a heavy lift on.
And that's exactly correct. And that's what we see quite a bit is the C value added, something, the meat on the bone type of stuff is actually, that cap rate is a lot lower than the B stabilized property. And so
one of the things that I think is important for all your listeners to really understand too is that just because you go deeper down the spectrum and it's maybe a little heavier value add, if you're projecting rents that really are not achievable, no matter what you do to it, there may be a specific demographic. And one of the key metrics that we look at is within a 1 mile radius, what does that household income look like? Because if you're improving the rents and maybe one person is getting those rents and the rest of the 1 mile radius can't afford those kinds of rent increases, we see this all the time. Value add players from Austin come into San Antonio, inferior submarket. I'm going to change the world, do a big renovation, and then their rents don't pan out. They were better off buying that maybe didn't have as good of a value add story, but they can work on the operations a little bit, and that's your value add, and still have a good return going in. I like those deals today because those are usually located in good neighborhoods, and you can have performance.
David, as you heard, Czar likes Waco, but I don't know if Czar knows that Chip and Joanna Gaines are on the last season of Fixer Upper. I wonder what that's going to do for Waco and the population. It's amazing how many people with that one show have come to live in Waco from all parts of the United States.
So how hyped up, Waco was sort of not on the map for a lot of people that never heard of the place. Suddenly, I had a friend of mine, and they were coming in from California and having us with all the kids and even the parents wanted to see first. They want to go down the Magnolia area and Waco. That was the first thing out. They didn't want to go to Billy Bob's. They didn't want to go and check out, Austin. They wanted to go and check out Waco. But when that show disappears, I mean, how much of that hype do you think will go away, and how much is permanent? And it's a big thing because a lot of people are investing in Waco right now.
I don't think the hype is likely to go away. I mean, the show gives it national visibility. Their football team gives them national visibility. The university is growing. And it's really any city between the two hottest markets in the country, Austin and Dallas, you're going to have those family offices that say, I'm done with paying these Dallas and Austin prices. And the capital migrates down the highway a little bit.
So how are you seeing business these days? 12 months ago, 24 months ago, what's going on today? How are you seeing business?
So the beginning half of the year after the election, I think people were a little bit stunned and they didn't know what the political climate was going to feel like or look like. They didn't know whether we were going to get tax reform, what we were going to get.
And a big run on the Treasury, too. That didn't help.
And yeah, exactly. And so with that big run in the Treasuries, volume really slowed down. And all summer we were going, dude, what's going on? And 2 weeks ago, we signed up 12 listings. So we think that we're going to have a fast run. I don't know if the year end will end up being the high volume years, but the first quarter for us is going to be good. And I think all of our competitors' first quarter is probably going to be very good. There's a big push to year end closings, but everybody usually they're pulling the trigger, signing listing agreements by August.
Right.
Some of them were waiting till September, mid-September, and to build all that collateral and get it through. We hope, and the push is to do by year end, but there's also a lot of people that think if there is tax reform, that they want to land in 2017 to hopefully be the beneficiary of.
How many offers are coming in on some of these properties that you have listed versus how it was, say, a year or two ago?
San Antonio, value add, 18 offers, 5 to 6 make it to best and final, go 2 rounds. Corpus Christi, tertiary markets, 5 or 6 offers, 1 or 2 make it to best and final, and they kind of duke it out.
What about quality of buyers these days? What are you seeing there?
From last cycle to this cycle, you see more sophistication. What's changed today in Central Texas is, especially a lot of the clients that you guys represent for financing, are smaller syndications, but they're more sophisticated. Before, we used to get guy that's selling out of 10 units, buying 100 units in San Antonio. This is his first big deal, and that big deal was $3 million. Today, you can raise amongst individual, doctors, lawyers, engineers, professionals, you can raise $8 million in Texas with returns that are similar to what the guys from California are expecting. And so you're seeing the quality of buyers improve. The sponsors they're newer, but they're also more sophisticated than the previous cycle's sponsors, where it was one guy, one equity check.
Yeah, and I would say just, one of the things that's unique about our team is we don't just do institutional, and we don't just do private capital. We run the gamut, and we've got 11 people on the team, and we've got folks that kind of cover all space. I would say the very bottom, meaning the very small BC, and the very high end, core, suburban core, and urban core assets, in those two spaces, we see the least demand. At the very bottom, in the very top. The most demand is going to be in that, 8-foot ceiling BC space and the 9-foot ceiling, kind of core plus or light value add space. That's the most frothy. And just to give you some statistics, as we looked and I haven't reviewed the latest statistics, but in the beginning of August, Texas multifamily transactional velocity was down about 27%. And as we're looking at it, as Czar said, midsummer, we were wrapping up spring executions. We had stuff under contract, but we weren't getting a lot of proposal volume. In other words, new listing, opportunities. And then all of a sudden it really just blew up. And we're, here we are going into fall with 15 assets either in the market or in pre-launch. And so I do think we're going to see a lot of ground made up in the fourth quarter. Now, when I say multifamily volume, I'm not talking about my team's volume. I'm talking about the state of Texas.
Right.
Okay. So I do think that fourth quarter is going to be big. It's always, historically, it's a big quarter because of year-end closings. But I think we will make up some ground, but we're not going to make up 27%. I think our volume will end up year over year will be down this year. But I do think we're going to have a very strong fourth and first quarter.
So how are these groups winning the deals? Is it price? Is it hard money up front? Is it because of past relationships with that particular buyer? I mean, what's counting now these days to win a deal? I mean, how are these guys winning these deals?
Sure. Barring a unique ability to look through a different lens than the rest of the buyers. In other words, I recently sold a trophy asset where we had in the best and final, we had 4 advisors and 1 private buyer. The private buyer was in 1031. He had a 40 to 50 year hold period. It's a legacy asset for his family trust, and he's competing against groups that were looking at 7 to 10 year holds. So he had a different lens, right? So, 30, 40 bips of cap rate over 40 years doesn't really move the needle a lot. So unless you can look at something through a different lens, pretty much people are pricing, as Czar says, pricing to perfection at the end of the process. And really what it comes down to is terms. And we're starting to, we're not starting. We've been seeing it through a good portion of the cycle. Not every asset has hard money day one, but, we have seen $15 million B value add in San Antonio trade because somebody went live with $250,000 day one. And that is
one of the
real
different things, though, is that in the A space, I'd say you're right. One of the things that's very important today is, do we know you? Do we know that had they been to see Dave and Paul, are they coming to the table without representation? If they're doing syndications, say through Lifestyles, and they're not going through Renee, we're like, please go through her because she's going to take you and walk you through. If you have the right professionals and you have the right relationships, it matters a lot because in the BC value add space, it's not necessarily where you start on price. It really is where you end up on price because there's the old strategy of, they call it kiss and punch. Kiss you on the front with the big price and then renegotiate you and punch you all the way down through the contract to renegotiate the price. So do we know you? How have you behaved before? We're going to call our competitors and say, hey, do you know this guy? Is he real? Do you know this gal? Is she real? Yes, they performed on our contract.
Yeah, we've had those conversations all the time with you guys.
Yep.
Asking us our opinion.
So one quick thing is compared to this cycle to the last cycle, how much 1031 exchange money is driving a lot of this stuff compared to the last time? I get the sense that there's a lot of 1031 money compared to last time where they have to find something, they have to close. Mm-hmm. What's that influence in the market right now?
Yeah, so in 2016, just to give you an idea, my team's volume, we did 86% of our transactions. In 2016, we closed 56 apartment deals.
Okay.
86% of our transactional volume had a down leg or an up leg exchange involved in it. And most of it was coming from California. Fast forward to today, in the beginning of the cycle, there were no exchanges. For the last 24 months, we've seen exchanges become more prevalent, but that volume is still down. I mean, I think the statistic is like 25% right now for multifamily involves in exchange.
One of the things that I think is we're starting to feel the pulse on, as all these investors have redone their value add deals at taking every piece of meat off of every piece of bone that they possibly could, is you're getting into a cycle where the yield is more important, the cap rate going in, than it is the value add. And you're seeing that West Coast California money that's trading at 2 and 3 caps looks at, I can buy high quality B renovated assets at, call it a 6 to 6.5 cap, a good return going in a good neighborhood. And we're starting to finally see some of that money come back in, whereas the Texas syndication money has typically been in the value add space, and they're still passing on some of those deals. They're saying price per unit's too high. But if you compare the returns on a price per unit in California to here, people are seeing that you can still get better arbitrage on your returns.
And the profile for small private has changed. So small private in the last cycle was an individual, doctor, lawyer, professional real estate investor that just did small assets. Today, it's syndicated. So what happens in a partnership at the end of a transaction? You pay it out, right? The partnership gets dissolved. You make your distributions. Everybody goes their own way. It's very difficult to 1031 with an entire LP structure. And so we don't see that as often.
Yeah.
Gotcha. So how close are these buyers these days with the final price? I mean, when something's listed for $15 million, I mean, what are we typically seeing with a...
Sure. We actually track not only our proposal pricing on assets that we list, but anything that we did a proposal on, whether we get the assignment or not, if it sells, we track the final price against our listing proposal price. And we just had a client ask us for this track record recently, and in an 18-month span, and this is running the gamut again, small private up to large trophy, we were $114,000 off from our middle strike to the final purchase price in 18 months of proposals. That's, I don't know how many it was, 60, 70, 80 proposals. A bunch. And we were only 100 grand off.
And sometimes
so it's pretty close.
We won't win the listing because we always try to be upfront, honest, realistic, and optimistic. But some other guys that may need the listing and need more inventory, they'll take it off the market or get it listed up for a bigger price, control the inventory, and then work them down. So our motto has always been give the clients the realistic feedback and fight for the price and fight for every renegotiation and retrade.
Yeah, fighting for the price is such an important piece of what you guys do. And to set expectations correctly for buyers, and you make an offer because you put out a written LOI, you guys look at it, and then you ask them in the best and final. And my question really is there a best and final one, a best and final two, and a best and final three? Are you guys kind of pulling that even farther?
It depends. So it really depends on what the seller wants to do. There's deals that you can buy it like eBay, buy it now, and buy it off the shelf, whether there's a whisper on it or not. There's deals that go through 3 rounds of best and final and then get a counter offer after you went through 3 rounds and say, hey, the deal's yours if, yes, you're the highest, but we need 100 grand more just because on a counter offer. So we're seeing, all kinds of situations. It all depends on what the motivation of what the seller needs.
Depends on how competitive it gets, and and
there's some instances where timing, if they've been in the asset for a long time and somebody's not the highest price, but they're willing to say, I'll give you 2 30-day extensions so you can go find a 1031 exchange, that's more frothy for somebody that's selling it than it's not just price every single time. But price is obviously a factor.
We have a lot of assets that we're marketing that have a strict year-end close requirement. For example, right now in this time period, that time period. And, it really depends. It just, for those sellers, they may not look to take every piece of cheese off the table, and they may be more concerned with, surety of close and quick diligence periods and getting to a deal, because we're not really at a deal until we have a significant amount of hard money, and we want to know that we have a deal.
No, I definitely agree that it's not always price on these deals. But talking about price, put your thinking cap on, give me an idea right now in a Class C property in San Antonio, what is the average per unit on a 1980s product?
80s is anywhere all the way on the south side in the 45 to 50 to 100 a door in premium locations in San Antonio. And it just really depends on what the dynamic is and where the jobs are. But 50 to 100 a door, the majority of it's really going in that call it 60 to 80 a door range is where the bulk of those transactions are happening.
Yeah, I would agree. I would also add to that by saying that in the 80s, we saw average unit sizes between 750 and 1,400 square feet in San Antonio. So you got to take the, sort of that cost per pound tongue in cheek. You got to look at it both ways. You got to look at it on a per foot basis. And we're now in San Antonio, we're now 110, 115, 120 a foot on some assets in the better location for BC stuff.
How about up here?
In Austin, so I would say just on a return profile standpoint, going in cap rates, you're looking at probably about a 50 bip delta between Austin and San Antonio. But the overall return profiles are the same. So the typical value add investors, 3 to 5 year hold, BC value add investors are typically trying to hit, high teens, low 20s on project level IRRs. So in San Antonio, that's going to translate today. It could be as low on stabilized asset that you could put permanent debt on it if you want to, and we can talk about how to goose those yields in just a second. But on stabilized assets, at least an average location, an average exterior condition, meaning that we're not going to have to spend a bunch of dough on exterior deferred maintenance that we're not going to get paid for.
Right.
If it's mainly unit interior renovations, then typically what we're seeing is sort of probably on the low side 5.85 on in place 90% tax adjusted cap rates, and as high as 6.25. So I would say on average, it's pretty safe to assume that your trailing 90 annualized with a 90% tax adjustment is going to fall somewhere around a 6. But the amortizing debt levered IRR will typically be in the low 20s, 21, 22, 23%. We typically see $4,000 to $5,000 kits going into those units, and we typically see anywhere from 10 to 13 cents a foot on rent lift. And those are just averages.
And that's just interior. Now,
Correct.
Now it's either discounted pricing or additional equity that's being required to clear the deferred maintenance. So if you have a property that you're putting all new hardy plank siding on and redoing all the roofs, well, the pricing will come down. But if you're doing the value add where you're just turning units, then we're looking at that $3,000 to $4,000 a unit upgrade kit to get $100 to $75.
Yeah.
In the last few minutes here before we say goodbye, help me help you. If I'm a seller of a deal, what do you need for me to give me the gas for you to sell the property at the highest price that you can?
Don't hire us at the last minute is number one. The earlier you can engage us, I've had listings for 18 months where we co-asset managed before we went to market to get them ready to go. If you come to us at the last minute, then there's very little we can do to affect the value other than brokerage execution. I mean, we won't share all of our secret sauce on that with you, but we're kind of hamstrung. If you engage us several months prior, then we can help to look at the asset, set it up. We could do a better job building our story in the graphics kit. If you come to us and say, I want to be in the market next week, I'm hiring you today, go out next week, then we're going to have to, hustle a book together and, we're not going to know the asset as well. Just get us engaged a little earlier and give us a fighting chance.
That's not to say we won't do it.
Of course.
But key things are, don't fire your manager before you go sell the property. So you have consistency that manager kind of knows what's going on. So when you do the walkthroughs.
Yeah, and one of the things that we're looking at, if it's been an untouched interior renovation, don't go renovating 20 units and then end up proving the market out that the rents are actually lower in the submarket. Let us sell the sizzle and push people on where their assumptions on rent increases are. Because if we're saying 150 and you prove out 75, well, there's not as much value add now that you proved out, and
That's
the value
right.
on the back end is not as high.
Yeah, and another thing that I think is important, which obviously should be relayed to sellers, is that just because the property goes under contract and it's all looking sweet, he doesn't jump on his cruise ship and head off. I mean, he's got to keep his foot on the gas throughout those 2 months of transaction time, underwriting time, especially with an agency deal, because if those numbers start dropping, it could affect loan proceeds and could end up with a retrade. So
one of the things that we always recommend to clients, they don't always take our recommendations, is to bonus out to staff when you're selling the property, because now they're on your team. Now they want to keep it full. They know that they'll have some sort of money when the deal's over, and whether or not the transaction happens or not, at the end of the day, they know that that seller is invested in them. And if you bonus the staff, we've seen it over and over and over again, that $5,000-$10,000 worth of bonus, you'll not have to pay in a retrade if you go down to 85% occupancy from 80.
Very important.
Yeah, let me give you guys, because I know that, you guys work pretty extensively with value add groups. I mean, you do a lot of volume in that space. And so one of the things that, we talked about, how do we find yield, or how can we engineer yield? A lot of groups will automatically go to permanent debt, and they'll say a deal it's stabilized, I'm going to do a value add, but I'm going to go to permanent debt, and I'm going to get a 75% loan, and I'm going to lock it up for 10 years at a low interest rate today, and then we can go do a supplemental on the back end. The reality is, if you look at, from an underwriting perspective, if you are going to do a value add, and you want to maximize leverage and whatnot, if you go to a bridge debt scenario where you're interest only for a 2 to 3 year period, and you're doing a renovation, even if you're only doing, a portion of the units in that time period, first of all, you can get, to 75 to 80% of the capital stack, not just the acquisition price, but the loan to cost, which would include your rehab budget. And in addition to that, when you go to refinance it and put permanent debt on it in 3 years, you're returning a significant portion of your equity, and it really spikes your IRRs.
Yeah, Scott and I are on the exact same page. I mean, if you go into this value-added belief that you want to put this long-term permanent debt, it's sometimes going to hamstring the listing agents on the property, because those long-term permanent agency deals come with a large, significant prepayment penalty. That means that the person is buying it has to assume that debt. It could be lower leverage. So that's not always the best way of doing it. If you know on the front side you're only going to keep this deal for 2 or 3 years, and you should be able to find, whether it's through us or if you could find a long-term or a short-term bridge loan that could be non-recourse, that gives you the ability, when you guys go to list the property, it's free and clear, and somebody can get up to 75 or 70% leverage, up to 80% leverage on those deals. So I can't stress that's the right way of thinking. Is
well, also flexibility, right? So if you're a value add, especially if you're on your way up, the newer syndicators are in wealth accumulation mode, right? So they want to transact with more velocity. So the idea would be is if you put a 3-year bridge piece on it, and first of all, your IO, that whole term. Second is you're going to get your rehab costs can substantially be built into that structure typically. But more importantly, you now have a pivot point at year 3. You have an A-B exit strategy. Either A, we like the asset, or we feel like there's more meat on the bone and we want to refinance it to permanent. We're going to return a good chunk of our equity, and we're going to be significantly higher IRRs at that point in time. Or B, you also have the flexibility to just outright sell the asset in 3 years at the higher NOI, and you don't have any prepayment, yield maintenance, defeasance issues that are going to affect your net proceeds. So it gives you a lot more flexibility.
Scott has a new job at Old Capital. He's our new director of finance. I love it.
On our own personal deals, we do the same thing. Is most of the stuff that we're going to be in is going to be 1 to 3 years.
Yep.
We're selling. We obviously know the formula, but we try not to compete with our clients. We just getting into LP positions, but anybody that we're working with, those are the deals that they're doing. They're doing bridge, and you can get to the money faster. We always laugh with some of the other syndicators and say, you have the highest net worth that you can't spend any of that money because it's all tied up into the property. And they always make fun of us, and they say, you can spend all your money tomorrow and go broke. And what we like to see is being able to access that capital and redeploy it after 2 years and make double, triple returns on whatever our initial equity investment is.
So Scott and Czar are just a wealth of information in the Central Texas marketplace, whether it is as high as Waco or as low as Brownsville, right down that I-35 corridor, just a wealth of knowledge. And these guys really know their stuff, and I've known these guys for a long period of time. I think that these guys are the ones you want to talk to. So if someone wanted to reach out to you, Scott or Czar, what's the best way for somebody to say hello to you?
Give me a call. We're on the JLL website.
Well, they don't go to the JLL website. What do you have a email address?
Oh, yeah. czar.haro@jll.com.
czar.haro, Haro, at
jll.com.
am.jll.com.
We got an easier one.
Oh, we do?
Yeah.
I didn't know that. Do I have one of those?
Yep.
In Czar, your direct dial 210-839-2004
Yes.
is for Czar. And this is Scott. My direct dial is 512-368-7140. And my email is Scott, SCOTT, Lamontagne, LAMONTAGNE @am.jll.com.
some great information today. I do appreciate you guys being in the podcast. I've learned a ton of information. Dave, any last questions for these guys?
No, I think that these guys have covered the bases and are a wealth of information, and we really appreciate your time.
So again, Czar Haro and Scott are available. Track them down whenever you have a chance. Again, Dave Walls, Paul Peebles, have a great day. Thank you.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.